Good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. We have a few people who are going to be joining us here in the session just a bit, but I want to kind of just get us launched into tonight's class. Tonight's a very interactive session, so as you have questions about tonight's content, we encourage you to ask questions of us. You can use either the chat function in Zoom or the chat feature, Q&A function or the chat feature in Zoom. I'll make sure I get those questions answered for you on air. We're also recording tonight's class. So if you got to step away from your computer for a little bit, you can always take a look at the recorded version. That will be up on our YouTube channel tomorrow. So you can get a chance to look back and maybe refer to some of your notes. We're really excited to bring this content to you. This is a class that we provide to the Alumni Association 4 times a year. So we do this once a quarter. This is our summer version of the class. And believe it or not, summer is a really busy time of the year when it comes to home buying. And I think just a lot of people in general are kind of saying, hey, what are my options look like in today's housing market? Well, again, my name is Jason Maida. It's great to be with you this evening. So I am your facilitator tonight, presenter. I also work for an organization called American Pacific Mortgage. So we're the 9th largest lender in the country. I happen to be one of the top performers for American Pacific Mortgage. And we get a chance to support our communities in affordable home ownership. And we help educate our future first-time buyers on what their options look like in home buying. So we provide classes like this to help you with tools and resources to help you on this journey towards home ownership. So American Pacific Mortgage is a California-based company. So we're based out of Northern California, but we are a nationwide lender. Our team in particular does focus on first-time homebuyer programs. So if you're thinking about buying in the state of California, there are some wonderful first-time buyer programs that can help you and support you on that path towards home ownership. And we're going to talk a little bit about that in tonight's class. All right, well, here's what our talking points look like for tonight. So we're going to spend some time looking at the housing market, kind of what's happening, both from a value perspective, kind of what's happening from an inventory standpoint. We also want to spend some time talking a little bit about mortgage interest rates, what's happening with mortgage interest rates, and maybe what are some of the projections that we're looking at in terms of where rates are going this year and beyond. I also want to walk you through a rent versus buying kind of calculator, so we can kind of look at what does it look like if I continue to rent today versus what could it look like if I decide to purchase a home at some point in time. And then we want to kind of transition from there, talk a little bit about credit. We want to see if there's maybe some areas of opportunity to improve our credit score as we get ready to make our decision to purchase. So we're going to kind of walk you through some tips and tricks around credit resources. And then we're going to talk a little bit about loan programs that are available to you. Understand some of maybe the guidelines, if you will, for some of those programs, some of the terminology of some of those programs you've probably already heard about, but want to kind of give you a high level look at some of those programs. And then we're going to talk about savings for home ownership. We're going to talk about how do we save for down payment and closing costs as we prepare to make this financial decision. Again, we'll talk about first-time homebuyer programs, and then we'll look at the workflow of buying a house. So after tonight's class, where do I go from here? So I'm going to take you through what does it look like to go from tonight's class to understanding my options for home ownership to getting the keys to my house. And I'm proud to say that we've helped several of your fellow alum within UC Riverside purchase a home, and hopefully you have the opportunity to do that at some point in time. So that's kind of what our plan is for class. We're really excited that you decided to join us for tonight. I know there's other things you could be doing on a busy Wednesday night, but we're really excited that you've chosen to spend a little bit of time with us this evening. Our run time for tonight's class will take us up just about to the top of the hour. We will weave in some of the questions that we have from our audience in tonight's content, but we'll also carve out a little bit time at the end of class to answer any kind of follow-up questions that you might have. All right. Well, let's talk a little bit about buying a home. And, when we think about home ownership, it's probably going to be one of the largest financial decisions we decide to make. So our classes that we teach throughout the country will hopefully help inform future buyers on what those options and resources look like for them. And when you're considering that decision for home ownership, there's a lot of great benefits that come along with owning a home. So, even though when I'm buying in today's market, for example, where rates may be a little bit elevated, there still are opportunities to help lower the cost of my mortgage through refinancing at some point in time. So those that decide to enter today's market, they have the opportunity to really control what their future budget looks like or expenses look like in housing. So even though I might buy, like I said today, in a higher rate environment, it looks a lot different in the future when I have the opportunity to refinance. And let's face it, I don't have to worry about my landlord possibly increasing my rent when I decide to renew my lease maybe a year from now. Now, this purchase that we decide to make, it is an asset. And as that asset grows over time, my home is going up in value. So that's growth in equity. Now, that equity is established by looking at the market value of my home versus what I currently owe on my mortgage today. So for most of us across the country, that's our number one asset that we have. So that asset has the opportunity to create generational wealth for some families. So, obviously achieving real estate or earning equity in real estate is a big deal for many of our clients across the country. And this is an asset that has potential tax benefits as well. So potential tax deductibility of mortgage interest for those that qualify, as well as for some of the improvements that I make to my home, maybe energy efficient upgrades, those also can carry with it tax benefits too. So as we think about homeownership, I would say it's not necessarily an apples to apples comparison because all the great benefits that come along with owning a home. To kind of frame that up for our class, I thought I would walk you through one of our calculators that we have available to you. It's called our rent versus buying calculator. It essentially takes a look at what does it look like if I continue to go down the path of renting today versus what could it look like if I decide to purchase a home whenever that time frame looks like. And so, because I think a lot of our clients think that, just because I'm paying $2,500 a month in rent, that's what I need to budget myself for from a home buying perspective. And really, that just isn't necessarily the case. So I think this calculator really kind of helps frame that up for some of our future buyers. So let's kind of take a look at what this might look like. So we're going to make the assumption, and these numbers will look a little bit different for everyone. And by the way, we are going to be sharing out all of these slides from tonight's class with you. So we would encourage you, if you have some time, take a look at this calculator on your own. I think you'll find it to be pretty helpful for you as you're kind of getting the wheels turning, so to speak, in considering home ownership. So let's assume that we were purchasing a home at $650,000. We have a down payment of 3%. And we would essentially be financing 97% of that purchase price, or $630,500. All right. Now, assuming today's interest rates right around 6.5%, we would calculate that in. We assume like a 30-year fixed mortgage. And then we're going to look at a situation where a buyer is going to consider purchasing in today's market. So we have kind of more of a current date here. Let's kind of move the needle a little bit on this. Let's put this to today as of August 20th. We have mortgage insurance costs. And we're going to talk more about mortgage insurance in tonight's session, but ultimately, when I put less than 20% down to purchase a home, I will have mortgage insurance for my home financing. But we'll explain a little bit more about what that means for you as a buyer in just a bit in our mortgage insurance section of tonight's class. We have the tax rate assumption at 1.2 to 1.25%. We're not going to have any HOA dues in this particular scenario, but if I'm looking at purchasing a condominium, maybe a townhouse, there might be HOA dues. We assume some tax bracket information. So depending on what tax bracket I'm in, we have someone in a 25% tax bracket. We have the cost or maintenance associated with my home, what I might have to pay in selling my home at a future date, because we want to kind of bake that into the overall calculation. And then we assume that my home will appreciate about 3% on an annualized basis. All right. So those kind of go into the home ownership column, if you will. And then from a rental perspective, we're going to assume that we're paying today $3,000 a month in rent. Now, I know that's going to vary for many of us, depending on what part of the country or what part of the state we're renting in. We also assume some renter's insurance, and then the cost of my rent going up, we said 2% on an annualized basis. So here's what this calculator kind of comes back and tells us. So if we kind of scroll up a little bit, first of all, it's important to understand that our break-even point of buying versus renting happens at about 4 years. So what that essentially means is that I will be on the positive side if I decide to purchase after 4 years of owning that home versus continuing on that path of renting. So that's kind of what this graph tells us. Now, if we look at a certain number of years out, the further we get out in ownership, the more appreciation we get in our home, the more tax benefits we get, the more our kind of asset position grows. And so you can see in this scenario here, so if we look at, after year 10, my opportunity or my gain, if you will, in ownership versus renting after 10 years would be about $130,000. Now that assumes my appreciation rate of my home at 3%. That also assumes the tax benefits that I get with my home. And of course, over the course of the next 10 years, I'm paying down the principal balance of my loan through my monthly payments. So, as we think about home ownership, like I said, when we're making that comparison of our budgets, for example, we have to factor in all the great things that come into home ownership on that column. But then on the rental side, think about it. We're paying someone else's mortgage essentially through kind of lost money, if you will, on the rental side of things. All right. So I would encourage you, take some time when you have a free moment, try to do your own calculator. I think you'll find that to be a really helpful exercise as you're thinking more about home ownership. All right. Now, as we consider homeownership, we also want to consider, where is this housing market at right now, right? And I think we're in an interesting time in the housing market right now. I think we're seeing a little bit of a shift in terms of what's happening right now. More inventory is staying on the market longer, so longer supply or larger supply out there, which is giving more opportunities or options for our buyers. So that's an encouraging sign. This is probably some of the best inventory levels we've seen in the last 2 years. So that's encouraging. You can see as we look a little bit closer at the Riverside housing market, you can see kind of a flattening, if you will, in prices. Not necessarily a downturn, but I would say more of a flattening. It's interesting if we look at some of the statistics in today's market, 44% of all transactions being done in the market right now have some type of seller concession or contribution, meaning the seller is saying, we're going to credit the buyer funds towards their closing costs and prepaid items. So that's almost half of all real estate transactions being done right now. Why is that happening? Well, because we have more supply, there's more competition for sellers. That gives buyers a better edge. So, I would say in some markets across the country right now, we are shifting to more of a buyer's market in today's market. And you can see the Riverside market, homes are on the market 50 days right now. That's probably double the amount of time that we saw in the last class that we hosted for the Riverside alumni. So it does look a lot different in today's market. Now, median sales prices haven't come down. They're still, like I said, about flat right now. But more choices out there create better competition in the seller's market, which can, again, give buyers a little bit of an edge. Now, some buyers are on the sidelines right now waiting for interest rates to go lower. And, we're starting to see signs that interest rates are starting to drift a little bit lower. For those of you that are watching the economy really closely, there is, an indication that the Federal Reserve may cut interest rates at the September meeting. There's just over about an 80% chance that the Federal Reserve will cut rates in September. So we're watching that really carefully. In fact, the Federal Reserve was meeting off-site in Jackson Hole, Wyoming this week. And so we're getting some feedback from that session because we're trying to get some indications on what are they going to do with future rate cuts. Some believe that they'll cut rates another 3 times in 2025. Of course, in the housing market, we welcome any type of rate cuts because ultimately that will spill into lower cost of financing for our buyers. Now, if we look over the last 12 months in interest rates, we've seen kind of this kind of choppy ride here. We're currently on this kind of downward trend. Average interest rate is right around 6.6% today. That is really kind of like what we've seen is more of our 2025 lowest level. Not the lowest level we've seen over the last 12 months. We realized that about end of August. I think we're going to continue to be on this kind of choppy road, if you will, in interest rates, but we will eventually cycle down. I think we will see lower interest rates as we move towards the latter part of this year. Now, when we look back at the last 20 years of mortgage interest rates, I think it's important to understand where we've gone over the last 20 years because interest rates as well as home prices will cycle. So, we happen to be in a little bit of an elevated cycle, not as high as we saw back about a year ago, but certainly we're at we will see things cycle down. Now, 20 years ago, interest rates were about the same as they were today. Home prices were just a fraction of what they are today. But as you can see, interest rates will kind of move down accordingly, and they'll definitely move up as things change in the economy. And truly today, we are a global economy. These gray bars represent some of the economic challenges or changes in the market. This is the housing crisis of 2008. We see kind of this bar here representing the pandemic. And, I like to kind of reference this side of the cycle of interest rates because a lot of people think that, interest rates are going to hit 2.5% again at some point in time. Probably not super realistic because, if interest rates cycle down, that means something pretty catastrophic has happened globally. Historically, interest rates are in the high fours to low fives. That's generally where we see interest rates. And I do think we'll return to some of those levels, but it will take probably 2 or 3 years from today to reach those levels. Now, interest rates aren't the same for all buyers. So as we look at mortgage interest rates, there's a variety of different characteristics that go into interest rates. Things like credit score and eligibility for a specific program, the type of product I'm going to elect, how much I decide to finance, what my down payment might look like. And we haven't talked about this yet, but you can also look at buying down points for your financing. So you're paying additional funds out of pocket in order to bring down your mortgage interest rate. In today's market, we don't generally recommend clients doing that because in today's market, it's about a 3 to 4 year break even point for those investments to pay off for you. Because as I just mentioned to you, many of our clients that are buying in the 2025 market will probably consider refinancing in 2 or 3 years down the road. So it doesn't make a lot of sense to put a lot of expenses into your financing today if you're going to turn around and consider refinancing. Last thing to consider into the factors into your mortgage interest rate is the term of my loan. So traditionally, most first-time buyers are looking at a 30-year fixed term, but if I shrink that term down to maybe 20 years or 15 years, that can enable me to have a potential lower interest rate option. As we get a chance to meet with our clients to do one-on-one consultations, we're going to figure out the right program setup for you and give you the best coaching or guidance to help design the right product and figure out really what makes the most sense for you given your financial goals of homeownership. Well, one of the big things that plays a role in mortgage interest rate is credit. So in our classes, in this part of the class segment, we like to talk a little bit about credit and help kind of inform you on how we view credit so you can look at maybe some areas of opportunity for your own specific credit profile. Now, I think it's important to understand that every program has a minimum credit score. We put those up here on screen for you to view. And there are 3 different agencies for credit monitoring or credit reporting, I should say. That is Equifax, TransUnion, and Experian. So you guys are all familiar with those agencies. Now, in lending, we always look at the middle credit score that's reported by those 3 agencies. So for example, if my highest score is 760, let's say my middle score is 740, and my lowest score is 720, we're going to take 740 as the score we use to evaluate our product options. Now, if I'm going to apply jointly with my partner, and let's say my partner's at 700, 680, and 660, now my partner's middle score is 680. That 680 score would be the score we use for qualifying purposes. And that's important to understand because that can influence my interest rate, like we just kind of discussed, can influence the product that I can select, even the cost of mortgage insurance for my financing. Now, as we look at our credit file, and if we've had any past challenges, like let's say a late payment that we had in October of last year, it's going to impact me in the most recent 12 to 24 months from the date of the event. Now, the more I get away from that event of that late last payment, the better my credit score is going to improve over time. All right. Now, we're going to talk a little bit more about the weighting of credit score items, and we're going to specifically look at the mortgage score in just a bit. Now, there are 3 score models. There's a credit score model, a credit card score model, there's auto financing, and then there's a mortgage model. Now, for those of you that have subscribed to maybe Credit Karma or any of the other monitoring tools, they're generally going to use the credit card model. So when I get a chance to connect with clients for their consultations, we may see variations in their credit scores. And the only reason for that is because the mortgage score has a different weighting than what we would probably see in the credit card modeling or risk model. Now, here's a matrix to kind of help you along to identify like how long maybe a negative item might stay on your credit report. So if I had that late payment with my student loan back in October of last year, now it's probably not going to affect me on my score as much, maybe in November of this year, but it will stay, a late payment will stay with me for 7 years. All right. So it's gonna have that impression on your credit report. And things like bigger items like, collection accounts or severity in late last payments, those are going to have a lasting impression on my credit report. This is what the weighting looks like for the mortgage score. So I'm going to kind of walk you through each one of these sections. Hopefully it'll kind of trigger for you maybe an area of opportunity in your own credit profile. And certainly as we get a chance to meet with you to help you on your path towards homeownership, we'll help you also identify areas of opportunity because ultimately, encouraging to get that credit score higher is going to improve your options, but also decreases the cost of your overall mortgage financing. So let's look at the first weighting, which would be length of credit or 15% of the model. So the longer my credit profile is, the higher my credit score probably is. Now, kind of the shorter time period I've had credit open, probably the lesser my credit score is going to be. So that's 15% of the model. 20% is going to be how much new credit am I trying to open? So if I've recently opened new accounts in the last 6 to 12 months, probably going to have a little bit of a pullback in my credit score. If I'm also making inquiries on my credit report, specifically hard inquiries, so whether that's a credit card company or an auto financing lender has done a hard inquiry on your credit score, that will have a 20% impact on your credit score. Now, our process is a little bit different on the mortgage side because we only do a soft credit check when it comes to helping our clients design their financing options. The reason why we do a soft credit check is because a soft credit check does not impact your credit score at all. So we can help guide our clients through home ownership and help build home financing options without impacting their credit score. Now, eventually we will need to do a hard inquiry, but that doesn't come until we actually go under contract with the seller. So, a soft credit just enables us to design the financing, understand a little bit more about your credit without impacting your credit score. Now, the other component is amount owed, and that's 30%. That's probably, from my perspective, the biggest area of opportunity for most of our home buyers that I help throughout the country. That is around revolving credit or credit utilization. So we're looking at credit balances that are outstanding today versus what available credit limits I have. So for example, I have $10,000 in credit limits and I have $5,000 in credit balances. Today, I'm at 50% utilization of credit. If a client was in that scenario, I would encourage them to now try to get those balances down to 30% or $3,000 in outstanding balances. Once I've reached that level of achievement, then I would really try to get to 10% or $1,000 or less in outstanding credit card balances. Now, let me give you a quick tip in managing your credit card accounts to try to maximize credit score. So if you look at one of your credit card statements, there's two important dates on those credit cards. There's the credit card statement date or billing cycle date. There's also the due date. So many of you are probably paying your payments on your due date, which there's nothing wrong with that. But here's what I would ask you to kind of change a little bit. Try to pay down your credit cards or pay them off before the end of the billing cycle date. And here's what you accomplish when you do that. One is what you're doing by paying it off before the end of the billing cycle date is you're getting that payment to post before all of the credit activity reaches the credit bureaus. And so you're basically bringing that balance down. So when the credit card issuer sends out your information to the agencies, you have a much lower balance, much improved available credit, which is lower utilization, therefore lifting your credit score. So a little bit of a tweak in terms of how you make your credit card payments, but you're essentially trying to catch that before the end of the billing cycle date. The last component to the credit card or credit score model for mortgage is looking at payment history. So we're looking at late payments that span 30 days, 60-day lates, and then 90+ day delinquencies. The more severe my late payment is, the bigger impact I'm going to have to my credit score, especially in the most recent 12 to 24 months. And you can see that's 35% of the weighting for the mortgage score. Now, one of the things that also appears in credit reports is student loans. And I know many of our clients are coming online with payments. So they've come out of forbearance and now they're restarting their payment plans with their student loan servicer. So if you're currently active on a payment, that's totally fine. Now, if you're in an income-based repayment plan where let's say you have $75,000 in debt, in student loan debt, and you're making a $250 payment, we can use that payment to qualify you right away for your mortgage. Now, if you're in a forbearance today or you have deferment of your student loan, then on an FHA financing loan, we would by default have to use 0.5% of the balances to calculate your monthly payment. So, that would be $375 in monthly payment. If you're looking at a Fannie Mae or a conventional loan in general, we would use 1% of the balances to determine what the student loan payment would be. We have to look at that because in financing, we take a look at expenses versus your income. And that we call that debt to income ratio. And I'm going to walk you guys through that calculation in just a bit. But I think your takeaway in the student loan segment is to understand that if you're not actively repaying on student loans, that's okay. But when we have that situation, we have to look at a default number in order to determine your projected expenses on the student loans. All right, I'm going to before we go into the loan programs, I want to just take a quick pause. Any questions from our audience so far that I can help answer while we're in session here? All right, and you can use, again, either the chat feature or Q&A in Zoom, and we have both windows up, so we'll get those monitored for you. So we'll look for any questions to come in. But let's kind of continue on with the conversation. And as we think about student loans, the reason why we have to evaluate student loans is because every loan program has set guidelines that we have to adhere to as lenders. So I want to kind of walk you through a high level look at some of these programs because many of the loan terminology you've already heard about. So let's kind of dive in a little bit deeper. So the first product would be a conventional loan. So that's a Fannie Mae, Freddie Mac loan, minimum down payment of 3% up to the conforming loan limit, which is 806,500. And it does have a minimum credit score of 620. Now, if you guys are in the LA market, maybe you're in San Diego County, or maybe you're in Orange County, we can go to higher loan amounts. However, when we stretch beyond that 806,500 loan amount, then the minimum down payment will jump from 3% to 5% on the conventional home loan product. We call that increase the high balance loan level limit. So as a first-time buyer, you can go up to 3% in down payment up to 806,500. Now that maximum loan amount does change every year. So FHFA sets maximum loan limits based upon changes in cost of living. We generally get those loan amounts updated right around September or October. The next product is the FHA home loan. That is a government insured loan, government backed loan, has a minimum down payment of 3.5%. The maximum loan amount does vary by the county that you're going to buy in, and it does have a minimum credit score of 580. You can go up to $1,209,750 in LA County, still minimum down payment of 3.5%. However, if you're in Riverside, San Bernardino County, those maximum loan amounts are lower. Now, I want to kind of tie these two products together, FHA and USDA, because these are both government insured loans. FHA stands for the Federal Housing Administration. USDA stands for the United States Department of Agriculture. The reason I want to tie these two together is because there are residency changes, unfortunately, on these programs. So just a couple months ago, they made an announcement that only permanent residents have access to both of these products that are both government insured products. So you do have to be a permanent resident. Now, if you're a non-resident, you can still leverage or utilize the conventional home loan through Fannie Mae or Freddie Mac. But unfortunately, we've had these guideline changes a couple months ago with both FHA and USDA for residency status. Now, the USDA loan is designed to help clients that want to purchase in more rural areas. Let's say you're looking to purchase maybe in a desert community, for example. You can utilize USDA. It does have a zero down payment option. You can see the minimum credit score on screen, and the maximum loan amount will change based upon where the property is located. There's two qualifiers to USDA. It's looking at the income by the household, also the location of the property. And then the jumbo home loan, it allows first-time buyers or buyers in general to purchase at higher loan levels that really stretch beyond some of the agency limits that we have and we've reviewed tonight. Not really going to be commonplace for many first-time buyers to leverage the jumbo product, but certainly is a resource that's available to you as well. And then the VA home loan is for our veterans that have eligibility on the VA home loan product. It is a zero down payment option, minimum credit score of 620 with really no cap on loan amount. And of course, this product is reserved for our veterans. The VA product has a lot more flexibility or leniency in qualifying just to encourage participation from the veteran in home ownership. Now, as we look at products, we also kind of have to look a little bit further into down payment levels and how that impacts us from a mortgage insurance perspective. So I want to kind of spend some time talking a little about two forms of mortgage insurance. One is PMI, which is called private mortgage insurance. That is tied together with conventional home loans. And then there's upfront mortgage insurance, or MIP, I should say, mortgage insurance premium, that is tied together with FHA government insured loans. So let's take a look first at the conventional home loan. So it comes into play when we put less than 20% down. So PMI stands for private mortgage insurance. There's about 7 or 8 companies that provide this benefit. And that benefit basically insures the lender against default by the buyer. So if the buyer was having some economic challenges, couldn't make their mortgage payment, the PMI company would back the lender against default. Now, PMI is based upon a few important factors. So it's based upon down payment, credit score, and then how much you finance. So the higher my down payment is, the higher my credit score is, the lesser costs I'm going to pay from a mortgage insurance perspective. Now, one of the benefits with PMI is that when I reach 2 years in my home and I have 20 to 22% equity, I can apply to have the mortgage insurance cancel, which was one of the bigger benefits with the conventional home loan product. Now, for those of you that have started your home search on some of the search sites like Redfin or Zillow, if you're utilizing some of the calculators there, you're going to get kind of a mortgage insurance number that looks significantly inflated from what we have here on screen because it's not taking into account some of the key elements that go into mortgage insurance calculations. So, for example, if I'm going to buy, let's say, a $450,000 house and I'm putting 3% down and I'm doing a conventional home loan, my mortgage insurance costs are probably about $138 a month. Okay. So not maybe as high as you might see on some of the online calculators. So I think that's one of the big kind of misconceptions about mortgage insurance is that it's really not as expensive as you might think. So I know a lot of us want to push towards the 20% down payment, but if we happen to put 10% down or 15% down, it's not going to be as costly as you might think. Now, as we kind of transition over to the FHA home loan, so the FHA loan, when I put 3.5% down, well, really, regardless of down payment, I am going to have two forms of mortgage insurance. So on the MIP, there's monthly mortgage insurance, which is 0.55% of my total loan amount. And then we kind of divide that by 12, and then we get a dollar amount on a monthly basis. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. And that gets added into my total amount finance. Now, different than the conventional loan, FHA loan requires, it really doesn't have a cancellation option on mortgage insurance. So for me to exit mortgage insurance on an FHA loan, I have to look at refinancing into more of a conventional home loan product to eliminate my mortgage insurance costs. Now, if we compare side by side the FHA versus conventional, here's what the FHA calculation looks like. So I take that same $450,000 loan amount, we finance in the upfront mortgage insurance plus the monthly mortgage insurance, and that you can see that on screen here. So obviously we're going to see a higher expense structure with the FHA loan versus the conventional loan. But, I think as we compare which product matches better for our clients, we're going to look at eligibility based upon the guidelines. So, maybe we see a little bit more flexibility in the FHA product than we might see from the conventional loan product. That's displayed by some of the minimum credit score requirements for FHA as compared to conventional. And certainly as we look at the guidelines for FHA, we'll have a little bit more flexibility there as well too. I look at the FHA product as more of a entry-level point to homeownership for our buyers. So maybe we're looking at FHA because maybe we're in a challenge situation from a credit score perspective or income perspective to expenses, but we'll use the FHA as that entry to homeownership. And then as things maybe improve in my financial profile, then we would certainly look to potentially refinance into a conventional loan at some point in time. All right, so we're going to kind of transition into income or employment for homeownership. So what we're going to do is kind of walk you through some thoughts around, how do I, or where do I need to be from an employment and income perspective? And before we kind of dive in there, I want to kind of share with you just a quick documentation list that most of our buyers would utilize as they prepare for homeownership. So as you're considering connecting with us for a consultation, these are generally some of the items that we would request during our application process. Okay, let's talk a little bit about employment for homeownership. And as we evaluate eligibility for our clients, we're going to look at the last 2 years of employment and/or educational history. So the example I use for a lot of our alumni associations in our classes is that, let's say, for example, I graduated from UCR in the fall of 2024, and I just started my new job in January of 25. Well, technically, I've been on my job for less than 2 years, but I can bridge that 2-year gap by using maybe my undergrad that I did at UC Riverside to make up my full 2-year history. So, the misconception in the marketplace is that I have to be on my job for 2 years. We don't necessarily have to have that. We just have to piece together 2 years of employment and/or educational history. That even holds true in transition to new jobs. So if I've been in the workforce for, let's say, 4 years and I've been in my job for that entire 4-year time, but I have an opportunity to go to a new employer, I could potentially, even though I'm not going to be with that new employer for 2 years, if I have an executed offer letter, we can potentially use that offer letter to help me qualify for my prospective home loan financing. Now, where that 2-year rule gets a little bit more challenging is for some of our self-employed clients. So if you're on a 1099 basis or you've opened up your own business, we do have to show that you filed 2 years of tax returns consecutively. to be able to utilize that income for qualifying. The 2-year rule also applies for those that have dual employment. So if I'm working for 2 different employers and I want to count both sources of income, then I have to show that I've been on both jobs simultaneously for the last 2 years. That would even apply for someone that maybe has a 40-hour work week job during the week, but then maybe decides to drive for Uber or Lyft on the weekends. If I do want to count both sources of income, then I have to display that I've been on both jobs simultaneously for the last 2 years. All right. Now, one of the things that some of our clients have is variable compensation components. So let's say I have a quarterly bonus or an annual bonus that I receive, or maybe I'm working in technology and I receive restricted shares as part of my compensation plan. Those streams of income can be counted in qualifying for a mortgage. However, if I do want to count variable sources like that, in that case, I do have to show that I've been with my employer for at least 2 years simultaneously. Last thing I just want to touch on income is other sources or supplemental sources of income. So let's say my partner contributes to our income and expenses for the household. If I want to use my partner's income to help qualify for the mortgage, then we have to include my partner on the application to qualify for the mortgage. So I can't use undisclosed sources of income unless they're going to be part of the application for financing. All right. So that kind of gives you a look into employment and how we view income. Now, we also take a look at income versus expenses, and we call that debt to income ratio. That's a calculation we walk through to determine what percentage of your income is being consumed by current expenses we have today, things like personal loans, credit cards, maybe auto loans, as well as my projected housing expense. Looking at the principal and interest of my new loan, maybe the property taxes for my house, my homeowner's insurance, as well as maybe mortgage insurance if I'm deciding to put less than 20% down. So we take a look at those expenses versus the income, and we've provided a kind of a calculation or formula on screen here. So we have a scenario here where someone's paying $2,500 in housing expense on a monthly basis. They have $500 in other debts, and they're making $8,500 in pre-tax income. So that would basically have someone that essentially has $3,000 in expenses versus $8,500 in income, which means that 35% of their pre-tax income is being consumed by those expenses. Now, in lending, we generally would not want those expenses to be more than 45 to as high as 50% debt to income ratio. Now, the question I get from our prospective clients is, Jason, where should my debt to income ratio be? I would say the comfort zone for most clients is probably this excellent level, which would be probably 33 to 36%. But ultimately, everybody has a little bit of a different tolerance level when it comes to debt to income ratio. Our more important metric that we're going to look at is affordability. Like, what does it need to look like to make sure this is an affordable opportunity for you? But certainly the debt to income ratio gives us a guideline from an underwriting perspective on what we can get to. Now, so that's kind of how we look at expenses versus income. Now, we also take a look at savings or assets for home ownership. And so in today's session, in this part of tonight's session, I should say, I want to kind of walk you through some of the documents that we would generally want to validate when it comes to some of the assets that they're going to use for your purchase of your home. And so we're going to take a look at that, but I also want to walk you through a savings plan for home ownership. So as we prepare to take on this financial milestone, what are some resources that we can do to start savings today? So let's look at some of the available asset accounts that are available for us to utilize in home ownership. So obviously cash accounts like checking and savings accounts can be used. We do have to trace all of the assets used in home ownership for the last 60 days. Any type of large deposits or cash deposits have to be, cash deposits can't be used. Large deposits just have to be kind of paper trailed back to the originating source. You can certainly use 401ks, 403bs, brokerage accounts can be used. I would encourage you, before you access those type of asset accounts, talk to your tax or financial advisor and make sure there's no tax implications in accessing those accounts, but they can certainly be used in financing. And then gift funds can be also used in a home purchase. So that's where a family member is basically helping contribute towards your purchase. There is no seasoning requirements with those type of assets. There's just a documentation trail that we have to go through. Things like a gift letter that's going to be completed by the family member, and then we have to see the transfer of the funds. But gift funds, certainly in first-time buyer purchases, are used quite frequently. So certainly an option for you as well as prospective buyers. Now, savings for homeownership can be one of the bigger challenges to obtaining that goal of homeownership. So in this part of our class, I just want to kind of walk you through a really quick exercise in savings for homeownership. So it looks a little bit like this. So let's say I'm in a position today where I'm paying $2,000 a month in rent. But after consulting with us for homeownership, we feel like our budget can get to about $3,500 from a homeownership standpoint. So that's about a $1,500 increase in outgoing and housing expense. Now, if we're trying to kind of build up savings for homeownership, here's what I would encourage our client to do is when we make that rental payment on the first of the month for $2,000, what I would encourage our client to do is let's start saving today like I'm making that $3,500 projected housing payment. So on the first of the month, when I pay my landlord the $2,000 a month, I get in the habit of taking an additional $1,500 and transferring it right to my savings account. By doing that, over the next 6 months, now I've accrued $9,000 in savings, right? Over 12 months, I now accrue $18,000 in savings, and it makes homeownership so much more of a near-term goal for us. And you're also going to be able to potentially participate in a high yield account, which is going to give you interest on that money that you're saving. So not only am I building a savings account for myself and creating that nest egg for homeownership, but I'm also creating that discipline of getting in the habit of making that $3,500 mortgage payment. So when I eventually get the keys to my house and I have to make that first mortgage payment, it doesn't feel like such a big stretch in my budget to pay that $3,500 on a monthly basis. Now, that's a really simple approach to savings, but I think at the same time, super effective to help build that resource for you or support for you as you're trying to get your savings together in homeownership. Now, there's also assistance programs can also help you make homeownership so much more of a near-term goal. Now, we're proud to partner with CalHFA, which stands for the California Housing Finance Agency. You may have seen CalHFA in the LA Times or other news outlets for some of the programs that we've offered, like the Dream for All program, which it looks like we may have some future funding on that program. But CalHFA is designed to help support low to moderate income families in homeownership. So we're proud to be the #1 partner for CalHFA all across the state. And so I wanted to kind of spend some time as we get towards the latter part of tonight's class, giving you kind of a look into some of the resources that are available to you with CalHFA. So the first program that's one of our more popular programs is called MyHome Assistance, which provides up to 3% of the sales price in assistance on a conventional loan, 3.5% on an FHA loan. So if you kind of go back to our product segment, essentially covers the minimum down payment for either one of those products. Now, what CalHFA provides in this assistance is a low interest rate loan for those resources at a 1% simple interest rate loan. And that assistance is not required to be paid back until you either sell the home or if you decide to refinance in the future. Now, for some of our clients that need additional resources, there's the My Access program, also the ZIP Assistance program. They can provide more resources for closing costs and closing costs and prepaid items in your home purchase. Now, the 2.5% My Access is 2.5% of your loan amount in additional assistance. It's an additional 1% simple interest rate loan that we can add into the home buying plan, or the ZIP Assistance program, which provides 2% of the loan amount at 0% interest. The way this would work is if that client needs additional resources that stretch beyond maybe the My Home Assistance capabilities, then we can bolt on these two programs or either one of these programs. Now, it does elevate the cost of the first mortgage interest rate. So if at all possible, we really want to kind of lean into just the My Home Assistance program to be able to try to create that lower interest rate opportunity for our clients. Now, there's also other programs that we have available within APM that stretch beyond the CalHFA suite of products, like the Pathway DPA program available on FHA products. It's 3.5% to 5% of the sales price in assistance. That does require repayment on a monthly basis. A little slightly higher interest rate offering on that. So our CalHFA program, if you're buying in California, would be probably the #1 option. And then we have kind of a other option scenario with one of the GSFA product or the Pathway program. Now, if you decide to incorporate the CalHFA program into your home buying plan, here's what this would look like. And the top kind of like scenario shows you what a traditional home purchase would look like for a $450,000 sales price. So let's say I do decide to buy a $450,000 home as a standard conventional loan. I would probably need my down payment of 3%, which in this case would be $13,500, plus closing costs and what we call as prepaid items, which generally we encourage clients to budget 2 to 3% of their sales price for that amount of funds. So that would equate to about $22,500 to $27,000 in savings that I would essentially need to have. And that could be a stretch for some of our first-time buyers looking to achieve home ownership. So that's where CalHFA assistance programs come into play. So if I took that same $450,000 scenario, and you can see this down here, if I incorporate, let's say, the My Home Assistance Program, now I would have that 3% assistance to cover my down payment minimum. And then maybe I don't have to save as much. Maybe I only need to save up for my closing costs, maybe my $9,000 to $13,500. If I needed additional resources, then I could incorporate maybe the My Access or the ZIP Assistance Program to lower that total out-of-pocket expense. So theoretically, I could have up to $24,000 in resources available to me as a first-time buyer. Now, one of the nice things about the CalHFA program is it's a very inclusive product. The income limits go up to 150% of the median income in your market. In fact, we just had those income limits updated just a couple months ago. It does have a minimum credit score at 640 on an FHA loan, 680 on a conventional loan, and the debt to income ratio stretches up to 45 to 50%. One of the unique attributes of the CalHFA program is we only look at income shown on the application, not necessarily the household income. So one way of getting participation in the program is if I can qualify maybe in just my income, let's say I make $150,000 a year and my spouse makes $100,000 a year. Well, in LA County, we would be within the income limits just off of my income. Combined, we wouldn't. So if I'm able to achieve the home purchase price that would actually be most attractive to us based upon my income, then we would be able to participate in, say, the CalHFA program. So the CalHFA program is eligible for first-time buyers, which basically is someone that hasn't owned a home in the last 3 years, and it's available for any type of one-unit property, single-family homes, condos, townhouses, even manufactured homes that are on owned land. So it wouldn't be eligible for mobile home parks or anything like that, but it would be eligible for any one-unit property. All right, so the CalHFA product is a wonderful option for our clients, and I wanted to pass along some of the income limits for the surrounding Southern California market counties, so you can kind of take a look at that. But we are an expert on these programs as the #1 lender in the state. So if it's something that you find as maybe a tool that you'd like to have in your path towards home ownership, we can certainly provide those resources to you. All right, so we had a question that came in the chat. I want to answer this before we dive into the workflow of home buying. And the question is, would it be wise to consider homeownership if you're living paycheck to paycheck or part-time? How about you're currently unemployed? So, I think those are conversations to have maybe in a one-on-one situation. I think if you're in a situation where you're just trying to get to the next payroll period and maybe it's a little bit more challenging to get to savings, I think that's where we maybe have a financial conversation of like, what tweaks can we make in our monthly budget to help us maybe carve out more savings for ourselves, or maybe we set a cycle time in home ownership of maybe 1 to 2 or 3 years down the road. But those are conversations that we have all the time with our clients, because let's face it, we are in a high cost of living market and it's not easy with the cost of housing. So we certainly will help kind of provide some financial kind of 101, if you will, to help kind of prepare you for home ownership. All right. Appreciate the question. So let's talk a little bit about the workflow of buying a house. Now, after you leave tonight's class, we would love to connect with you for a free consultation. That consultation allows me to meet with you to design your own plan for home ownership. Whether you're looking to buy this year or maybe 2 years from now, like we had the question in the chat, we want to just make sure you understand your options in home ownership. And so this is what kind of the next steps look like from tonight's class. So if we do meet for a consultation, that consultation allows us to put the roadmap together for you for home ownership. Now, part of that consultation's output will be to have you pre-approved for your home purchase, which essentially tells the seller that you're eligible with your financing. We look that we've validated income, assets, credit, everything is kind of put together properly, and now you can start making offers on homes. Now, that pre-approval is good for 60 days, but we can recertify it at any time. So that takes us through step 1. Step 2 is the house hunting or home searching phase of the process. We would encourage you, as you're looking online, you're going to eventually transition to looking at homes in person. to connect with a local realtor. Part of our work across the market is to connect with preferred realtors. We can make an introduction to one of our preferred realtors when you need that resource for yourself as well. But realtors should be an expert in their market, be good at negotiations, have a good network within their sphere of influence that can help provide you the right resources that you need as a first-time buyer. Now, as you go through the home search, I stay very connected with our clients, whether it's on text or call or email, because a client may want to make an offer on a home. We want to make sure we can provide them with real-time details of what a prospective home buying scenario might look like for them. Now, let's say you find the home that you love, you make an offer on that home, and let's say the seller accepts your offer. Well, that's a huge accomplishment in of itself, because now you have a ratified agreement with you and the seller for that prospective property. Now, on the date of that ratified contract or agreement with the seller, you're going to get a call from me saying, hey, congratulations, you have your offer accepted. Let's talk a little bit about next steps in the process and get you scheduled for your follow-up video session. We generally do those consultations within 2 to 3 days after the accepted offer. Now, as a buyer, you will have action items on your side to complete, which will include having your earnest money deposit delivered to the escrow company within a few days. That's usually 1 to 2% of your purchase price, and that counts towards your total out-of-pocket expense. Now, within a real estate contract in California, there are contingencies as part of the contract that allow you to do your due diligence on the property or your research. That research includes getting your house appraised, which as your lender will get an appraisal order to ensure the value supports your purchase price for your home. Your realtor will help orchestrate inspections for your home to make sure that maybe the sewer line is in good position, make sure the roof is intact, whatever inspections your realtor feels that are needed on this specific property. And then as your lender, we're going to get your loan approved. And usually the contingency period runs in the first 10 to 17 days of the contract. So when we think about home ownership and going from step 3 all the way to step 6 when we get the keys to our house, traditionally that takes about 30 days. Now in some markets, it can be short as 14 to 21 days, depending on the agreement with the seller. Okay, now question came in. I just want to answer this before we go into the next milestone, which is, if I live in Northern California, can I meet with you or someone in my area? So we work with clients all across the country. We work with clients virtually, so it's on video, but we do have brick and mortar offices across the country. Depending on what city you are in Northern California, we have one of our home bases in Sacramento. But again, we work with our clients virtually, which seems to be most convenient for clients in this day and age, but you're certainly more than welcome to come one of our local offices. We'll talk a little bit about next steps for your consultations in just a bit. Now, as we move through this milestones in the process, so step 4 is processing and underwriting. That's kind of more of the administrative functions of the lending process. We're going to verify things like employment, your assets, your credit. We want to make sure everything is kind of put together properly for your financing, because now we're going to prepare to go to the underwriting phase of the process. Now that takes us to step 5 when an underwriter has now issued a loan approval for your financing. Now by that time, we've got the loan approval back from the underwriter. We've also gotten the appraisal back to ensure that the value supports the purchase price of the home. And now that almost takes us to about 3/4 of the way through the process. Now, as you go through every one of these milestones, you're going to be getting notification updates from us via text, via email, and you'll be getting disclosures through the process that provides clarity on what your financing looks like. And that will be after we do a follow-up consultation with you. Now, at step 5, you're also going to be at the end of your contingency period. So if all your investigative work checks out, you feel really good about the property, then you can sign off on your contingencies, and that tells the seller that you're ready to move to the final stages of the process. And as we move to the final stages of the process, we're going to provide a final closing disclosure to you. It gives you a 3-day cooling off period before we get to step 6 in the process. Now, what step 6 means is that's the closing of the home loan. That's when you're signing final loan documents with a public notary in your area. Generally, those notaries will come directly to you for the signing of your loan documents. On that day, you'll also deliver your final funds for your closing. We'll deliver the final funds for your financing and any type of assistance programs you've elected. And then documents get recorded with the local county recorder's office. So if we're in Riverside County, we'll record a grant deed to transfer ownership as well as the deed for the financing. And as soon as those items get confirmed as recorded, then I get a chance to make my favorite call of the day. In fact, I made one of those calls just before today's class to tell our new homeowners that you did it. You're now a new homeowner. We've had everything confirmed with the county, and now it's time to celebrate the huge accomplishment of homeownership. I at least get a chance to make 2 or 3 calls like that a day. Best part of my day, of course, aside from teaching our classes like this throughout the week. But it truly is a huge accomplishment in achieving homeownership. Now, our relationships with our clients don't stop there, because as part of our aftercare process, we always stay connected with our clients. Because as I mentioned earlier in our class, is that maybe you're buying in today's market where rates are a little bit more elevated. Well, as rates cycle down and refinance opportunities present itself, we want to make sure that we're there as a resource for you. So all of our clients are enrolled in our HomeBot system to track your equity progress in your home, as well as our Rate Watch system to monitor what's happening with mortgage interest rates. Well, as we wrap up tonight's class, I want to kind of just give you an idea of like, what do next steps look like for you? I know we've had a few questions in the chat about, connecting with us for a consultation. So our free consultation is how we support our communities in designing home buying financing for them. And so, as we kind of leave tonight's class, we have a really simple 3-step process. It includes building your own online application profile. We do a soft credit check, but that does not impact your credit score. And then you would upload proof of income as well as your asset statements, and then use our scheduling system to schedule your 30-minute video consultation. I meet with all of our clients from our classes to personally design their home buying options for them. And you don't have to feel pressured to buy, whether you're looking at this as a goal for a year or 2 years down the road, or buying today in today's market. The consultation allows you to at least have a plan towards home ownership. Here's what that consultation looks like. We're going to look at your budget of home ownership. Where do you want to buy? Look at some different tools like assistance programs to help maybe decrease your out-of-pocket expense, kind of give you a sense of where interest rates are at based upon the time of your consultation. And just like I said, put together a comprehensive plan for you in home ownership. Now, as we kind of finish off tonight's class, I wanted to point out to you one of our technology resources. We really embrace technology in supporting our clients. Now, it doesn't replace the human touch in the home buying process. Again, this is one of the biggest financial decisions you're going to make, but we leverage AI, we leverage mobile in our process. Our mobile tools can help you start the application right from your phones. You can follow the progress of your loan, even use the calculator function within mobile. So really great tool to help you have another resource for you in this journey towards home ownership. I want to point out to you our UC Riverside alumni discount. So not only do you have access to our 4 classes throughout the year, but we discount our closing costs for you in home ownership. And like I mentioned to you, as part of our consultation service, it is a free service we provide to you in helping build your plan. Now, if you've enjoyed tonight's content, I hope you've had some some good takeaways from tonight's class. We'd encourage you to share this content with friends, family, coworkers. We'll teach over 60 classes in our local markets in homeownership. We have probably 20, 25 classes left on the calendar for 2025. We would love to have your friends or family members attend these classes. We again are recording tonight's class. We are going to send back out all of the presentation material slides from tonight, as well as the links for our YouTube channel that you can view tonight's class recording. Here's all my contact information. So if you want to follow up with me after tonight's class, feel free to message me or call me. Love to be able to answer any questions you might have. And we have all of our social channels up as well. We love what our community says about us in homeownership, the experiences they have. We understand, how big of an opportunity this is for you as buyers, but we also understand what a big decision this is and how much trust you're putting us to help get you to the finish line in home ownership. So we'd love for you to check out what our clients are saying about us on our socials like Instagram, our Reddit, or whether they're on our Google reviews. We really are proud about what our communities say about us. So that kind of brings us to the end of tonight's class. I hope you guys enjoyed some of the content we provided to you tonight. I try to answer as many questions as possible. If you have some follow-up questions before we wrap up tonight's class, we'd encourage you just drop those in the Q&A or chat function. And hopefully we get a chance to connect with you for your own future consultation to help you on this journey towards home ownership. So I'll stay around a little bit longer here. We'll keep the lines open if you do have any questions. And then if we don't have anything else, then we'll go ahead and get signed off tonight. But I'll go ahead and just leave the lines open for a little bit for any questions that you might have. Okay, I'll just wait just in case anybody's typing away. We'll keep the chat open here. So I think we might be good. All right. And I appreciate those who did decide to send in some questions. Hopefully you got the right answers. And I really encourage you, if you want to kind of have a one-on-one to look at your own situation, we'd love to be able to get connected with you. And then question in the chat was, are you an accredited Better Business Bureau company? We are, absolutely. So yeah, we are definitely a participating member of Better Business Bureau. So feel free to check out us there as well too. All right. Thank you for that. All right. Well, thank you so much for attending tonight's class. It's been a pleasure presenting this content to you. Please feel free to reach out to me if there's anything I can help with in the future. And we look forward to staying connected with you and hopefully meeting with you for a future consultation. Have a great night.